When we're looking for income, we're often told that we cannot beat the market with a high income investment product. Here, I've disguised the name of the product, but what I want to show you is this chart here. Over 13 years, the S&P 500 has been going through this massive bull run. It's returned 450%. This is an income product, BDC. Its total return is very comparable to the S&P 500 with dividends reinvested. This, my friends, has been returning 13.7% per annum in total when we reinvest the dividends over the last 13 years. What company is it, and why should you care? Let's get into it. All right, I'm back here on the Business Development BDC Universe page. Again, this is a free data set. It's got a huge amount of data here that is difficult or impossible to get on other platforms. Now, at the moment, I've got the different BDCs here listed alphabetically by ticker. Now, the business development companies, these are income vehicles, essentially. They take money in and they lend it out to small growing companies. They'll usually either make a loan or they'll take an equity stake in it. They receive that money back and they pay out most of this to investors like you and me. Now, they're registered investment companies, and so there's limits on how much debt they can take on themselves compared to the assets that they have. And it gives them some degree of stability. Now, what I want to see here is I want the NAV total return. So this is a combination of net asset value, the underlying value of the assets being held, and total return, that is the income that they pay out. Now, that Main Street Capital is my absolute undoubted favourite here. And it has by far the best NAV total return over 3 years. But then we get down to this bunch here, where we've got 50%, 50%, and then several BDCs in the 40s here as well. Now, the top one here is a company called Corp. Now, I've done a video on this company before, and there's a couple of key things that I want to point out here right now today. First of all, the discount and premium. A comment that I often get, and my main hesitation at the moment for investing in Main Street Capital at the current prices, is the price per share is 65% higher than the actual net asset values per share, or the assets being held by the company per share. Now, if you don't have a platform that has net asset value, you can simply look up the price to book ratio, and it gives you a very close proxy that'll be sufficient for most purposes. And you'll see that the price to book ratio is indeed quite high, particularly if you compared, say, Main versus Fidus Investment Corporation here. Now, Fidus is trading at a 3% premium. Now, that is virtually no premium. Now, also look at the market yield. Main Street Capital, it does have a fantastic yield, but partly because of the much smaller premium here, Fidus has a stronger current yield. Leverage amounts are very comparable. Portfolio debt is very comparable. The variable debt here, we've got Fidus as more variable debt, and it has more first and second lien loans as well, which would mean that the portfolio here is probably going to be safer, slightly marginally safer, than Main Street Capital if we were to hit a recession. Now, there are, of course, many other good companies here. Hercules Capital is one where I've had positions in the past, as well as Capital Southwest. And again, you'll see that they are trading at enormous premiums. Another company that you might want to take a look at would be Gladstone Capital. And again, it's trading at a premium, but it's a more manageable or pleasant premium in my mind than what we see with Main Street Capital, Hercules, or Capital Southwest. Where do we go from here? How do we understand what Fidus is doing and whether or not this is going to be a good or a sensible investment for us to look at? Let's get some more details. When we want more information, it's often the very best plan to visit the website for the companies that we're looking at. We often get much more in-depth detailed data and insight than we'll get from a regular stock investment platform. Now, here we are on the investor relations page for Fidus. Note up here as well, it says visit our advisor's site. Now, this is an externally managed BDC, which means that there's higher costs associated with it than there will be with an internally managed BDC. Now, that's something we might just have to be comfortable with. Now, if we look under Investor Alerts, Investor Resources, there's several information points there. What I want to look at, though, here is the news and events, news releases and events and presentations. Now, I love presentations, and they've got this massive archive here of conference calls. If you want, you can look through those. But the first thing I want to do right now is walk through the investor presentation from Q2 in 2024. All right, now I'm going to work backwards here. I just love this final slide on the slide deck. As we work backwards, though, we can see obviously there is a lot of tables here and a lot of insight. They give us insight into the investment portfolio as of the end of June 2024. Now, as we look at this, for example, there's a lot of information here available for us to assess. And advise you to take the time to have a look at this because there's some really important points in here as well for us as an investor. What can we learn from these slides on the slide deck? They've got details about the portfolio companies, the values here are in thousands. This column here gives us some idea of the sector so that we can get a sense of the diversification over different sectors for these companies. We can see the investment types here. So we've got, for example, first lien debt and equity here. We have warrants here. We have subordinated debt here, for example, or a pure equity holding here. We've got the cost here as well as the fair value. Now, as we go down here, there's obviously a lot more to be seen on this column. But we've got building products manufacturing, information technology services, retail, distribution, restaurants. So we've got a fair aerospace and defense manufacturing. We have a fairly diverse set of businesses here that Fidus is actually investing in. And that can be a huge advantage to understand and know a little bit about the type of investments that they're making. And if you had any questions about these companies as well, you could actually go away and do your research on the companies that the investment corporation here is actually taking a stake in with equity investments or the first lien debt. All right. Now, this slide on the slide deck is quite a nice overview, and this represents many of the elements of the company that make it attractive to me. Number one, we've got that proven investment track record. So they've got a very nice dividend yield, and that's on the trailing 12 months. And that includes, though, the supplemental and special cash dividends. They've got a return on equity of 12.5%, and that exceeds the average BDC performance. So they're better than average, which is always something you want to look at, I think, in my mind, when we're looking at a sector. And they've got the SBIC debt that provides a lower cost of capital. Now, I'd like to come back to this point later because this is one of, I think, the distinctions for Fidus compared to some other BDC investment companies. Now, they've got a highly experienced team. You can, I believe, hire this sort of capability in terms of the average amount of professional experience. But I think this, for me, is also a really core point. The core investment team has worked together for 20 years. This is not something we can buy. This is not something we can hire in. This is not something we can manufacture. For me, this teamwork, this understanding, this comprehension of the others and how they think and what makes them tick is going to be an absolutely powerful part of the corporation here. And for me, as an investor, this is not even its own bullet point, but for me, this is something I am looking for and something that gets me very excited. Now, the deal origination network. So this is in the lower middle market. That's where they've always focused since their inception 12 years ago. And this is important as well. It has attractive risk-adjusted returns. They've got a very selective deal screening process, and they have an investment close rate of less than 2.5%. If you're putting that into perspective, out of 100 companies that they screen through, they're only going to invest in about 2.5 of those 100 companies. And that is really good. I love this selectivity. I love the way they're not just going out there, putting money everywhere and hoping for the best. Now, as they do this, they're focused on the seasoned companies, so companies with a track record, companies that otherwise have difficulty accessing capital markets, And they have an explicit focus here on revenue and positive cash flow, all of which is going to be absolutely crucial for these firms, which Fidus is investing in. It's going to be crucial for these firms to be successful. And that becomes important when you're lending them money. Now, in terms of how they generate growth, I love to see this, the monetization of mature equity investments. So over time, they cycle out some of the equity investments and they recycle them to grow net investment income. And this is also important. They have a lot of upside here through equity distributions and appreciations as well for their investors. Now, I said I wanted to come back to this idea of the SBIC that was referenced earlier in the video. Now, it was one of the latest slides, but this is where they introduce earlier on in the slide deck what exactly the SBIC is. Now, they were initially licensed as a small business investment company, an SBIC. Now, that becomes really, really interesting. And we're going to get into that because this SBIC license gives them access to low-cost fixed-rate unsecured debt financing. So they are able to get low-cost financing. It's also interesting in the current environment where we've seen very high interest rates. This is a fixed rate. And so as the floating interest rates that they lend at, as those interest rates increase, the gap between the interest rates that they're lending at versus this fixed rate that they're borrowing at, that becomes a bigger gap, and it has been incredibly profitable for Fidus over the last several years. Now, coming back to the SBIC, I think this is a really important part of the overall, what they call the liability profile. So they borrow money and they lend out money, and they make profit from the difference in how much they pay to borrow versus how much they earn when they lend. Now, because of how they are structured, they have a $100 million senior secured floating rate syndicate revolving credit facility. A very convoluted terminology. Now, because of how they're structured, they have this $100 million senior secured floating rate syndicated revolving credit facility. Whoa! They've also got 5-year unsecured fixed rate notes, and they have a 10-year fixed rate SBIC debentures. Now, I think this is a very important point here, which gives them some very powerful ability to be very successful in the marketplace. Now, it's also very helpful because as of halfway through 2024, 93% of their outstanding liabilities are fixed rate obligations. So this doesn't go up, it doesn't go down, it's fixed rate at 4.5%, which is very powerful for the company as well. And the reason that this is very powerful is it means that they can do very well because of that fixed rate nature. Now, it's also important to note here, one thing that I'll be keeping a very close eye on here is the relatively high amount here of $250 million in the 5-year unsecured fixed rate notes. That's going to take or create, I think, quite a big hit and potential risk to the company after 2026. Now, the reason that I think it's going to be challenging for them is if we look at this debt maturity schedule, we can see that it dwarfs the other amounts of debt here that is maturing. And if we look at, for example, these values here, $250 million is roughly 1/2 of these values here. Now, the total values. Now, as we begin to look at this, it's split into 2 tranches here in 2026, in January and November. So that'll give them the opportunity to stagger and to manage this a bit more effectively. But the other interesting point here as well is this maturity in 2026. The blended rates are about 4.8 and 3.5%, which are much lower than they will be if we were looking at taking on or issuing these secured or unsecured notes, today. Now, if they were to roll over today, this blended rate would be much higher, and that would reduce the profitability of Fidus. Hopefully by 2026, the interest rates will be lower than they are today in mid-2024, so that they can replace this with a blended rate which is closer, but probably still going to be higher than these values here. But this is something I'll be looking closely at, and essentially we've got to think 1.5 years really before The unsecured notes are due in January 2026. And so I think that will give them ample time here to manage the situation. Now, this is an important element here as well. So we're looking at the outstanding debt and the regulatory leverage. And this regulatory leverage here is showing it's increased into 2020, and they've been working in the last several years to bring this down. So the regulatory leverage here is only at 0.4 times, which is overall a very safe and secure amount of leverage for them to take on and use. Now, how do they make money? Well, this is the proven investment strategy that they do talk about. They provide both debt and equity financing solutions, and there's a number of different types of events and situations in which you might partner with Fidus. They use a highly selective private equity style underwriting methodology, and as we noted, out of 100 opportunities they look at, they pass on most of those, and only a very vanishingly small 2.5% of those opportunities are opportunities that they will invest in ultimately. They have a very strong proactive risk management focus, and I think this is the key point down here on the slide, is they focus on the capital preservation, on risk management, while leaving the potential there for upside as well. And as we've noted elsewhere, they have some first lien loans. They also have some second lien subordinated debt, as well as quite a bit of equity in there as well, providing them with some good long-term upside potential. And one of the elements that I absolutely love about Fidus is this lower middle market focus. Now, it's often the case that smaller companies that are underserved can be profitably served by the right corporations. But in many cases, the size of the opportunity isn't going to be big enough for larger players. Now, that leaves niche players like Fidus available and open to take advantage of the situation. Now, this is a large number of companies with relatively small annual revenues, which do need capital. They do need additional investments in them so that they can actually grow and become more successful. Now, the great financial crisis, the GFC, led to a withdrawal of many financing sources a decade and a half ago, and this is made worse in the aftermath of the COVID-19 crisis, where a lot of these smaller companies are just unable to get access to the capital that they need. Now, when we look at this, they put in place, so they don't just lend money like we might lend to our brother or sister-in-law. They actually put in place some very nice risk-adjusted returns. So the companies that they're lending to don't have a lot of other options. There's been the exit of many other financing sources, and so the companies here that Fidus is lending to enable the companies are prepared to pay a higher price or a higher cost for the financing that they're receiving from Fidus, and this is fantastic. But Fidus, though, they're not just lending money left and centre on the back of a handshake. They are putting in place protections and covenants and agreements that actually enable them to manage their risk, and this is part of that downside protection or risk management that they put in place, or capital preservation, which is a really important part of what they do and how they do it. Now, when they have so many opportunities, it's important that they're able to find the right investment opportunities. Now, to be honest, we could very much use exactly the same set of investment criteria here that Fidus uses when we look at our own investments when we're investing in companies in the stock market. And in fact, I would say there's, with the exception of the sort of size distinction here, I'm looking for many of the same elements when I'm making investments in the stock market. That they're like niche market leaders where there's a strong defensible market position, some clear and identifiable competitive advantages. They don't want to see a company that is heavily reliant on a customer or a supplier. So in other words, if the company has a single customer and that customer takes their business elsewhere, it would put Fidus's investment at risk. So they try and avoid those types of situations with that very strong reliance on customers or suppliers. They are looking for good value and equity cushions, and there's different financing or exit options for them, so they're not stuck or locked into that type of investment. So that means that there's going to be a little bit more flexibility for them. They like experienced, successful management teams, They like to be aligned with the owners of the companies, so the owners of the companies have a strong stake in the success and long-term success of the company. This is what you will see many stock market investors also looking at. Now, it's more difficult to assess this with most companies that we're investing in the stock market. We can look at, for example, a list of the managers and how long they've been with the company. We can look at ownership stakes in the company, but it's definitely more of a qualitative part of the assessment process there. And of course, well-defined value creation strategies. So looking for growth, looking for the ability to consolidate within a fragmented marketplace. They have the ability to improve their operational capacity, or there's also some opportunistic sort of one-off opportunities here for the company to take advantage of, where Fidus is able to come in and basically provide the ability for them to take advantage and then profit from this in the long run with the successful partnership. Now, when they look at the overall investment process, so they've got a deal flow or a flow of opportunities is another way of looking at this. They get roughly 600 opportunities that come across their desk that are pitched to them every year. And that's based on a 5-year average. And so that will be a bit higher some years and a bit lower other years. So they've got this origination of investment opportunities, and then they undergo due diligence, so initial meetings, a quick review of some of the key historical and operational details and documentation. They'll then undertake a set of financial modelling in-house to really understand, and I think as well here when we think about cycle testing, making sure that this is an opportunity that isn't just going to look good when times are good, but that if there is a recession, that these are companies that will be able to survive and manage. They then run it through their investment committee and increase the due diligence, and then they look at this issue term sheet. So this is where they really do a lot more due diligence as well, and they go into this in much more detail. It's also important to think that they're looking not just at this company, but also doing a deeper dive into the industry research. Now, because they often specialize in several industries, they've got lots of investments in those industries, and so they've already got a lot of this industry research already done. So there's some economies of scale here. They're forward-looking as well, so not just what's happened in the past, but given the current economic or political environment, what might happen in the future. They also get into the organizations. They want to see the factory. They want to see the offices. They want to talk to the people in many cases, as well as also looking at third-party diligence reviews. So additional insight and analysis there as well from other parties. Now, after all of this, it goes through their formal investment committee review and approval before all of the closing documentation is prepared. Whew! Now, with all of that, we get 600 deals coming in, and we have a close rate of 2.5%. And that, my friends, is, as I say, a disciplined investment process. So who exactly is on their team? Under the executive management, they've got corporate legal financing, they've got the legal team, they've got third-party investigators and data and service providers. Investment and the origination team here. If we look down at this table, we've got a number of different industry expertise areas here, and between them they cover a wide range of industries. Now they've also got industry experience listed there, and perhaps most importantly, the number of years that they have been at Fidus as well. And that's absolutely important because of the way in which they're able to collaborate, they're able to work together, they understand and can work in unison as a team. Now, it's also important to look at the overall track record. Now, the past doesn't guarantee the future, but it gives you some insight into what they've done and how they've done in the past, which gives us some understanding of whether or not their overall approach has been successful, and it gives us some confidence about whether or not it may be successful in the future. Now we'll zoom into the charts a little bit as well, but what we can see here in terms of the dividend and distributions, as of the slide deck, the trailing 12-month yield is 14%. It's a little bit less than that now because of price appreciation over the last several weeks, but they've had 32 special supplemental dividends since their IPO 13 years ago, I think. And then also the overall capital preservation here is important. So the NAV net has been consistently above IPO levels for 52 consecutive quarters, which is a fantastic outcome, I think, long term. So they've certainly achieved capital preservation of their net asset value with time. And the next thing I want to do is just to look at these pictures in a little bit more detail. Okay, so now we are zooming in very much as well. What we can see here is from 2011 and then 2012 as the full years, we can see the amount of dividends. It's a very different pattern to what we might see with Main or what we might think of as a dividend growth investment machine, where we see the level of regular dividends increasing year on, year out. We can see here that it was held pretty much constant for about 4 or 5 years here. Then we took a dip into 2020. I think that would probably be a result of the COVID pandemic. And we've seen this grey, the regular dividend per share, beginning to increase here. And that's partly, I think, due to the overall floating interest rates, which have really pushed up their ability to earn investment income here. And in fact, what we've seen is not just the regular dividends increasing, but also the supplementary in purple here, dividends per share, and also in dark blue, the special dividends per share. Now, this other orange line here is important as well, because it's suggesting at the moment that they've got 113% dividend coverage. So they could pay the dividend out and keep on paying and still have a reasonable amount of money left over. So their income is indeed, the net investment income is covering their dividend very nicely, very safely. And you can see since 2020, this line of dividend coverage has been increasing and going up as well, which bodes, I think, for the future. Now, not only are they an income machine, they're also a very safe growth machine here in terms of the net asset value or the growth of the value of the company. Now, there's two parts to this. There's the net asset value as well as the cumulative level of dividends adding up year after year. If we look at this, then the grey line is the grey bars at the bottom here, the net asset value per share at IPO of $14.46. And we can see over here in blue, the level of the net asset value has increased. It hasn't gone down below the $14 per share. And I think it's important to note that the chart here on the left-hand side, the scale starts at 13 to 14. So this grey bar here is 14.46, and here this level of representation here is actually only 44 cents. So keep that in mind, that there's a issue. If we extended the scale out, this would look like a very small amount here. So they've zoomed in a little bit. In some ways, it's a little bit deceptive because it makes it look as though there's been this amazing net asset value per share growth, but it's simply because we've cut off $13 of value on the scale. So it allows us to see the detail, but it can also potentially, I think, be relatively deceptive here. Now, I think this is also important here is the cumulative dividends plus the net asset value. So if you're thinking about this is like your total shareholder value that you've gained. So if you invested here in 2011, $15.10, and if you'd held it for all of this period of time, that one share would have been now worth $42.31, comprised of a growth in the net asset value per share, as well as all of those beautiful, sweet dividends that they would have been paying you. That, my friends, is, in my mind, a growth monster machine. What do you think about Fidus? It sounds, or it may sound as though I'm gushing here, that I'm absolutely passionately in love with this company. Now, the truth is I'm not. As we saw, the dividends don't just keep on increasing every year on year, as we see with other companies, for example, such as Main Street Capital. It's not, in my mind, a perfect company, but it is very well run, and it is also not trading at a substantial premium to the net asset value as Main Street Capital is today. So I think in that respect, it's a much safer investment. I'm not overpaying for the net asset value of these shares when I buy them. Now, of course, the other big question is, how well does this track as an investment? So let's have a look at some quick comparisons. Ares Capital, the beautiful long-term buy and holds in the BDC space. Now, if you just reinvested all of the dividends and you had invested in Fidus and Ares Capital when Fidus was first listed in 2011, this is what you would have had over the last 13.2 years. You would have seen that Fidus would have delivered a stronger total annual return. Now, if you're looking at this, then Fidus would have returned during this period a $54,300 value on your $10,000 invested. compared to Ares Capital actually at about $9,000 less, at only $45,000. Now, if you take away the dividend reinvestment, Fidus would have outperformed also, although only just a little bit. And so I think from this we can see that if you like Ares Capital, I think chances are good you should also have a good look at Fidus. And that I love Main Street Capital, and I don't claim that Fidus is as good as Main, and from the BDC Universe link and webpage we can see that Main had the most superior net asset value total returns of all of the companies in the BDC space over the last 3 years. And that 3 years is not a mistaken performance, they are a long-term performer. Now, if you look at this, for example, since Fidus's inception, Main Street Capital has had a stronger average annual total return. It's actually substantially higher, in my mind, than Fidus. And in fact, if you just invested $10,000 in each company, reinvested the dividends, we would see that Main Street Capital would indeed have a higher value here if you just invested those dividends again and again. Now, even without the dividends, Main Street would have done better because of their stronger focus on equity investments than Fidus has. And so that's allowed Main Street to more or less grow at a faster rate over time, which is why even without the dividends being reinvested, you would have come out ahead. Now, the proviso here is, of course, at the moment, the amazing performance of Main Street Capital basically means that the price to book or the price to NAV value is high. It's well above 1, which means that you're paying a lot of money for the net asset value per share. And now returning to one of the early charts as well, Fidus versus S&P 500. So now we know what we're looking at. How does it stack up against the broader stock market? Remarkably similar average annual total returns since when you reinvest the dividends, although obviously without the dividends the S&P 500 will blast Fidus out of the water. But in my mind, I think if you're looking for a good long-term buy and hold with good dividend reinvestment opportunities, I think Fidus is a good bet. This is where I am putting a lot of the capital at the moment for my family's investing. And I'm very keen to know what you think. Hit me up in the comments down below if you think this is indeed a really nice investment opportunity, or is there another BDC that you like more? And I'm very keen to learn why that might be.